On a Tuesday morning in late January 2026, Microsoft's stock fell 12% in a single day. $440 billion in shareholder value gone, just like that. The reason? The company had quietly disclosed something investors really didn't want to hear. Nearly half of Microsoft's massive cloud computing backlog, a backlog worth $625 billion, was tied to a single customer. A customer that, by its own internal projections, would lose $14 billion this year alone. That customer, of course, is OpenAI. And what happened to Microsoft that morning was a small preview of a much larger problem now quietly unfolding across the entire technology industry. Because in 2026, the four largest tech companies on Earth, Microsoft, Google, Amazon, and Meta, will spend a combined $725 billion on capital expenditures. That's up 77% from the $410 billion they spent last year. By 2027, Wall Street analysts expect the figure to top $1 trillion annually. Almost all of it is going into one thing: artificial intelligence. This is the largest, fastest infrastructure build-out in the history of capitalism. To put that in perspective, the Manhattan Project cost about $30 billion in today's money. The Apollo program, putting humans on the moon, cost roughly $288 billion over 13 years. Big tech is now spending more than that, every single year, on AI. But here's the strange part. The companies doing this spending are some of the most profitable businesses ever created. And yet, by every measure investors actually care about, free cash flow, capital efficiency, return on invested capital, these companies are getting weaker, not stronger. Here, we explain how economies, markets, businesses, and policies really work, in simple language for everyone. So as always, we've got some important questions to answer. How did the most profitable companies on Earth end up spending themselves toward negative cash flow? Why is so much of this money flowing in circles between the same handful of firms? And is this the start of a transformative new industrial era, or the largest tech bubble since the year 2000? To understand what's happening, you have to grasp the scale. In 2024, the combined capital expenditure of Microsoft, Alphabet, Amazon, and Meta was around $250 billion. That was already considered enormous. In 2025, it jumped to $410 billion. In 2026, it's projected to hit $725 billion. That's a tripling in 2 years. Where is the money going? Roughly 2/3 is flowing to GPUs and CPUs, the specialized chips that train and run AI models. Most of those chips come from one company, Nvidia. The rest is going to data center construction, power infrastructure, networking equipment, cooling systems, and the land needed to host it all. Microsoft alone said that $25 billion of its 2026 capex is just from rising memory chip prices. Why? Because AI data centers now consume 70% of the world's memory chip output. Demand has so completely outstripped supply that component costs are spiraling upward. Now, on the surface, the companies clearly are making money from this. Microsoft's cloud business is growing. Google Cloud revenue jumped 63% year over year last quarter. Amazon Web Services added $8 billion in revenue in a single quarter. So why are investors getting nervous? Because the gap between what's coming in and what's going out is widening fast. Microsoft expects its capex to jump again in 2027. Barclays estimates Microsoft's free cash flow will drop 28% this year before recovering. For Meta, the picture is worse. The company plans to spend up to $145 billion in 2026, more than double the $72 billion it spent in 2025. Barclays now sees Meta's free cash flow falling by close to 90%. When Meta announced its 2026 spending plans, the stock dropped 6% in after-hours trading. Investors weren't celebrating the AI investment. They were punishing the company for refusing to give a firm timeline on returns. But Amazon is the most extreme case. The company plans to spend $200 billion in 2026 alone. Morgan Stanley estimates this will produce negative free cash flow of $17 billion. Bank of America estimates a deficit closer to $28 billion. Just to be clear about what that means, This is one of the most profitable retailers and cloud providers on Earth, and it's about to spend more cash than it generates, for the first time in 20 years. And then there's OpenAI, the company at the center of the entire boom. OpenAI is, on paper, one of the fastest growing businesses ever created. Revenue went from $6 billion in 2024 to about $13 billion in 2025. Annualized revenue at the end of 2025 hit $20 billion, a milestone it took Google 7 years and Facebook 6 years to reach. But OpenAI is also losing money at a pace the world has never quite seen before. The company posted a $13.5 billion net loss in just the first half of 2025. Its own internal projections show losses of $14 billion in 2026, cumulative losses of $115 billion through 2029. The company doesn't expect to be cash flow positive until 2030. To put it another way, OpenAI is currently losing more money in a single year than the entire Manhattan Project cost in inflation-adjusted dollars. And here's where things get really interesting. To fund this, OpenAI has signed infrastructure contracts worth approximately $1.5 trillion over the next decade, with 7 different vendors. $300 billion to Oracle, $250 billion to Microsoft, $100 billion to Nvidia, $90 billion to AMD, $38 billion to Amazon Web Services, $22 billion to CoreWeave, $350 billion to Broadcom. $1.5 trillion in commitments from a company that, today, generates about $13 billion a year in revenue and loses $14 billion of it. You might be asking the obvious question, how does any of that math actually work? The answer is, it doesn't. At least, not in the way investors traditionally evaluate companies. What's actually happening is something economists are now calling the AI circular economy. And it works like this. Nvidia announces a $100 billion investment in OpenAI. OpenAI uses that money to buy GPUs from Nvidia. Oracle announces a $300 billion deal to provide cloud capacity to OpenAI. To deliver that capacity, Oracle needs to spend roughly $40 billion buying Nvidia chips. So, the cash flows like this. Nvidia invests in OpenAI. OpenAI pays Oracle. Oracle buys Nvidia chips. The money is, in significant part, moving in a closed loop. Each transaction gets recorded on the books as revenue. Each announcement boosts a stock price. When Oracle's deal with OpenAI was announced, the company's market cap jumped $244 billion in a single day. Larry Ellison, Oracle's co-founder, briefly became the world's richest person on the news. Nvidia's stock has soared past $4 trillion in valuation. The combined deals have added over $1 trillion to the market caps of the companies involved. But the actual cash flowing in from external customers, meaning customers outside this closed loop, is a small fraction of those announcements. This pattern has historical precedent, and it's not a happy one. In the late 1990s, telecom equipment companies like Lucent, Nortel, and Cisco financed the purchases of their own customers, the telecom carriers building out fiber optic networks. The carriers used that money to buy more equipment, which boosted Lucent's reported revenue, which sent Lucent's stock higher, which let Lucent borrow more money to lend to more carriers. It was vendor financing dressed up as growth. When demand fell short of forecasts, the entire structure collapsed. Multiple major telecom companies went bankrupt. Years of fiber optic capacity sat completely unused. Investors lost trillions of dollars. The Goldman Sachs research team has now noted that 2026's AI capex spending, measured as a percentage of US GDP, already matches the peak of the late 1990s dot-com investment boom. Bloomberg has documented the exact same circular financing patterns that destroyed Lucent and Nortel, this time involving Nvidia, OpenAI, Oracle, and CoreWeave. Even Nvidia's CEO, Jensen Huang, recently told investors that his company's $30 billion investment in OpenAI might be the last time Nvidia invests in the startup. The previously announced $100 billion commitment, now, in his own words, not in the cards. But here's the thing. The defenders of the AI boom argue that this time is genuinely different, and the bull case deserves to be taken seriously. Because if AI delivers what its proponents believe, a productivity revolution comparable to electricity or the internet, then today's spending isn't a bubble. It's a once-in-a-century land grab. The companies that own the infrastructure first will dominate the next 20 years of computing the way Microsoft dominated the PC era and Google dominated mobile. And the early signs aren't all bad. Microsoft's enterprise cloud backlog hit $462 billion last quarter. Real contracted revenue from real businesses paying for real AI services. Google Cloud is growing 63% year over year. Enterprises are signing 5-year deals to migrate critical workloads to AI-powered platforms. If just one of these companies emerges as the dominant AI infrastructure provider, the trillion-dollar valuations stop looking absurd and start looking conservative. Apple's market cap today is over $3 trillion, built almost entirely on the back of one product category: smartphones. The total addressable market for AI is, at least theoretically, far larger than smartphones ever were. In other words, if it works, the spending is justified. Spectacularly so. The question is whether it works fast enough to justify the burn. But the spending isn't the only issue. Even if the demand is there, 3 structural problems could still derail the entire boom. The first is the power grid. AI data centers are unbelievably power hungry. A single AI query can consume up to 1,000 times more electricity than a traditional Google search. Total US data center electricity demand is projected to reach 68 gigawatts by 2027, roughly equivalent to the entire electricity capacity of California. The problem is that the power grid wasn't built for this. In Virginia, the largest data center hub in America, grid connection requests are taking 4 to 7 years. The research firm Gartner estimates that by 2027, power shortages will restrict 40% of all AI data centers from operating at full capacity. Even if big tech has the cash to build the data centers, and the cash is becoming the question, the electricity to run them may simply not be there for years. The second structural problem is the unit economics of AI itself. Inference costs, the cost of actually running an AI model when a customer queries it, quadrupled in 2025. That's the opposite of what was supposed to happen. Software businesses traditionally get more profitable as they scale because the marginal cost of serving an additional user is essentially zero. AI is the opposite. Every additional user requires more chips, more electricity, more memory, more cooling. And open source AI models from Chinese labs like DeepSeek now match the performance of commercial models at essentially zero cost. If that trend continues, the entire premise of charging customers premium prices for AI services starts to crumble. The third problem is concentration. According to Microsoft's own disclosures, 45% of its $625 billion cloud backlog is tied to OpenAI. That's nearly half of one of the largest companies on Earth depending on a single customer that is itself losing $14 billion a year. If OpenAI's growth slows, or if its losses widen further, Microsoft has a serious problem. Oracle's credit rating is approaching junk status because of its AI infrastructure spending. The entire system has become, in the words of one analyst, a financial musical chairs. So where does all of this leave us? In the short term, through the rest of 2026, the AI capex boom continues. The hyperscalers have already committed to spending levels that are difficult to walk back. Most of them are building data centers that won't come online for 2 or 3 years. Even if they wanted to slow down, the contracts are signed, the construction is underway, and the political pressure to keep building is enormous. In the medium term, the next 2 to 4 years, the picture depends on a single question. Does AI generate enough genuine, external recurring revenue to justify $1 trillion a year in spending? If it does, if Microsoft, Google, Amazon, and Meta find new markets large enough to absorb this much compute, the current investments will look like one of the great capital allocation decisions in history. If it doesn't, this becomes the dot-com bubble of our time, with one important difference. The companies losing money are some of the most profitable in the world, so the unwind would be slower, but the eventual write-downs could be enormous. In the long term, the most likely scenario is somewhere in between. AI is real. The economic value will eventually justify some level of investment, but almost no one believes the current pace of spending, 77% annual growth in capex, can continue for more than another year or two without triggering a serious correction. When that correction comes, some of the companies in the circular financing loop will fail. Others will consolidate. The ones with genuine external revenue and real cash generation will survive and dominate the next decade. Here's the broader point. For 30 years, big tech was the most reliable money machine ever created. Apple, Microsoft, Google, Amazon. These were companies that generated such enormous free cash flow, they didn't know what to do with it. They paid dividends, they bought back shares, they sat on hundreds of billions of dollars in cash reserves. That era is, at least temporarily, over. For the first time in 20 years, the most successful companies on Earth are spending faster than they're earning, betting everything on a technology whose business model is still being figured out. Whether this becomes the largest economic transformation since electricity or the largest financial bubble since the year 2000 will define the next decade of the global economy. If you want to understand the broader context of how supply chain shifts are reshaping the global economy, we made a full video looking at how Vietnam quietly became Asia's next factory floor. That's the mechanics. See you in the next one.